And hello, we are here. This is a special live stream edition of Facts versus Feelings. Ryan and Sonu. Sonu, we're going to have a lot of fun today. And we've got a special intro music for Lindsey, and we want to get right to it. But welcome to Women's History Month, the special Facts versus Feelings, building community for women in finance. And we've got a busy day with a lot of awesome guests. So let's go ahead, Tori, and play Lindsey's music and get her in here. You're there.
Hi.
Hello. Hey, Lindsey, how you doing?
Good. I mean, I was expecting a little more upbeat music there.
Well, you know, markets are rough, you know.
It's March, and you know it's still cold in Chicago at least. So, yeah. Where are you, Lindsey?
So, well, this week I'm actually in New York City, but I'm based out of Charlotte. So, yeah, I'm with the team in New York today.
Awesome. Well, that's what we're going to talk about. We're going to get right into this again. Women's History Month, the special Facts versus Feelings live. We've talked to Lindsey. We've talked to you a couple times, right? Different places, different ways. Excited to have you on the podcast. This is the first time though you've been on Facts versus Feelings, I think, right? I think.
Yeah, so. This is my first time.
Okay.
All right, welcome.
So go easy on me, okay?
You only got 25 minutes, you know, so we'll get into it. And that's what we want to start with. We live in a world of compliance. We like names and titles. So give your name and title, but you just changed jobs. Tell us about that. That's I'm looking forward to hearing about this.
Yeah, so I'm Chief Market Strategist at Clearnomics, and Clearnomics is what we are. Is we're a platform for insights and information and charts and communications for advisors. We talk about the macro and we talk about markets, and we make it a lot easier for advisors to do that by providing them with the tools and the information, and we arm them with the data and the charts that they need to do that very simply and seamlessly.
So I'll let you jump in 1 second, Sonu. So I met James, I don't know, 2018, 2019, right? When he was starting your company, or his company, I should say. And I was always a fan, right? Watching what he was doing, building. And when I saw you were going there, like within 10 seconds, I was like, that's perfect. Like that's an awesome fit for what they've done. And now you can go out and do the strategy side of things and lay on and work with advisors like you have. I thought it was an amazing fit. So congrats to you and James, I think, on what looks like a great hire and hopefully a great move for your career. I was pumped for you. But Sonu, we've got less than 25 minutes now. I don't know what the clock is. Let's start firing away.
Let's actually we'll take it from there. Like Ryan and I do a lot of this. It feels like our day job, even night job, maybe more night job, is to make charts and get a handle on the data.
We're busy during the day.
It's a night job. Yeah. So, like, why are charts and stories important? I mean, the stories come out of the charts, obviously, but from your perspective, that's what you all do, right? Well, that's what you give advisors. Curious, like, why is that creating that narrative using charts important?
Yeah. I mean, I think everybody, you both would agree that it's using charts is really a visualization of making a story come to life. And it's all about, our business is all about storytelling, right? If your clients can't understand what's happening in the market, it really makes it more difficult for them to trust you, right? So I think that being able to tell a clear, concise, crisp story with charts, some people are more visual, others are less so. But either way, just being able to see the trends over longer periods of time, because that's what we're promoting, right? As long-term investing here. It really kind of helps. I think it helps clients really zoom out to understand what's happening in the world.
Well, long-term perspective is great. Absolutely.
I mean, I've made a career making charts and telling stories. So clearly I agree on everything we just said there. I listened to you with Joe Fahmy. I don't know when that was. I just listened to it the other day. That was an amazing podcast. Definitely check that out later if you guys want to learn a little bit more about Lindsey, and Joe's podcast is awesome. I love that story of your career, because obviously this is Women History Month. As a female in the industry, you kind of, you had an interesting career. Trust me, here's why I'm going with this. I've been fired. I've been laid off. I've had an interesting career. People see us on TV. They go, oh, that was an easy ride. No, like I was broke. I was unemployed. No, it was anything but easy to get where I am. And just talk a little bit about a woman in finance, but also just your career kind of bouncing around, because I think it's important to remind everybody it doesn't always go the way you think it's going to go.
Yeah, I would say I definitely did not have a straight line path from college to being chief market strategist at Clearnomics.
You didn't? Yeah.
And not only that, it wasn't like directly or clearly planned out either. I kind of had to go with the flow at certain points in time, but I was also very like, when I saw opportunity, I jumped on it, or if I knew it was time to make a change, I did that. So I've done a couple of different things throughout my career in financial services. I'll highlight one. I think one pivotal change for me happened when I was in my late 20s. I had this opportunity to go from working with institutional clients in investment banking and sell side research to work with Jim Cramer at thestreet.com. So I was making this pivot from institutional speaking that language to speaking to retail investors. And I was working on his charitable trust to help manage his small cap and mid cap charitable funds. But it was at thestreet.com, which was a small media company at the time. And it was going to be a major pay cut for me. But I thought the opportunity was really interesting. And I didn't know it at the time, but it was very critical and pivotal in my career, because with that opportunity, working with Jim and the other folks there, that's when I really got into doing media. That was the first opportunity I had to start doing videos and talking with people through different mediums like this. And I don't think that if I didn't do that, I wouldn't have the opportunities that came after that got me to the seat that I sit in today. And so that was very important. However, I did get laid off from that job.
Exactly. It happens.
So it happens. And I mean, it was like, now I feel like you get laid off and it's like no big deal. Everybody's used to getting laid off. But back then it was still kind of a big deal. The company was downsizing, but it didn't feel good at the time. But anyway, it's just, I think too, like this type of career, it's a collection of meeting folks like you, Ryan, and Sonu. I've got to know you a little bit better in more recent periods. I think it's just, you build a community throughout your career journey. And I think that the longer you're in the game, it helps to kind of shape you as a person, but also shape your career too. And I think for me, every step of the way was getting me closer to working with the people that I really enjoy working with and doing the things that honing in on doing the things that I really enjoy.
So we actually reached out to Stephanie Link also. She's on spring break, and I know you worked with Stephanie at the Street too, right?
Yeah, she was there. And so I would interview her and Jim Cramer on camera. It was like I was like in my 20s. Okay.
I mean,
so it was kind of nerve-wracking.
Jim's the greatest talker ever, and Stephanie's the most prepared person I've ever seen for anything. Like, you cannot fool her. Not that you try to fool her, but she is. If you're with her, you better bring your A game. So anyway, that's awesome. Well, go ahead, Sonu. That's a great reminder to the listeners that careers don't always go the way you think they're going to go.
I always think serendipity in this business is underrated, because you want to meet as many people as you do, and you never know what comes out of that, right? It may be 5 years down the road that person you met 5 years ago, that plays a big role in your next big career move or whatever it is, right? So let's tell young people, I mean, believe in serendipity. I mean, you may not appreciate it now, but at some point you will.
Yeah, no, I always say, like, always, people are always watching. So a lot of young people will think that it's like, you need to network with the people in direct proximity to you, whether it's on your team or, your surrounding team, but it's everybody around you is watching what you're doing. And, you have to put your A game out there at all times, even when you think nobody's looking, because somebody is, and you don't know, like you just said,
someone's always hovering.
Right. And that could turn into an opportunity. Like you said, 5 years down the road, like you might've forgot that you interacted with this person, but they didn't forget you.
You mentioned something dear to our hearts. And I'm joking, but mid and small caps. You're managing mid and small caps.
Oh gosh, do we have to
spend 20 minutes talking about that? But we won't. But let's just start with markets. We've had a little bit of volatility, 10% correction, and we've rallied today. I mean, the Fed's going to meet, in a couple of hours. This will be on the podcast as well. So we're recording this at mid-morning, March 19th for everyone listening. So this is before the Fed news and all of that. We've had some volatility. Do you think it's kind of like it's not a trick question. You can answer it any way you want. Do you think the lows are in for the year, or is there more to come? Condition on, I know there's not a perfect answer.
This is the easiest question I want to ask you too, by the way. Jesus, what a hard question.
Let me get my crystal ball out.
Yeah, exactly.
It's hard to say, but Ryan, I know you do a lot of analysis on this. Like the average decline in any given year is 14%. Or the average correction is. And so that, like, what we've just went through is, it was swifter than we've seen in the past, and it felt really uncomfortable. But it's actually a normal part of investing. It's a feature, not a bug, right? It was at the bottom. I'm not entirely sure, but what I like to look at, as you guys know, I'm a fundamental analyst at heart. That is my background. And when I look at the fundamentals that have supported the stock market up until the start of this year, they're still really intact. I think what got investors shaken up was obviously the tariff narrative, ramping up and escalating over time. And the longer that it has done that, has really changed the narrative from tariffs or, could potentially impact inflation to, oh my gosh, is this going to be a slowing growth story? But when I look at the fundamentals, we've still got earnings growth. It's double digits for the year. And I know a lot of folks will come on, and you guys know I spent some part of my career like really in the weeds of earnings numbers, and I still do lean on earnings growth because it is, as Larry Kudlow says, the mother's milk.
That's what drives returns, especially over the long term, right? Profits.
Right, exactly. Well, and so we're looking for double-digit earnings growth. It's come down, but guess what, guys? That's what happens in the first quarters. Earnings expectations get reduced because analysts are over optimistic, usually coming into the new year in most years. And so they need to kind of correct their expectations, but they don't do that until after they hear outlook and guidance from the companies that they're covering, right? So it takes a little bit of time to filter through the system. And usually it's the first quarter where we see the largest drop in earnings expectations. And so this is a normal course of business. Of course, we need to see what happens with tariffs. There's a lot of uncertainty about how that filters through the system. We saw in 2018, and we saw with the pandemic, that rising prices were pushed onto the consumer. This time might be a little bit of a different story. That's not the only way you deal with higher prices, right? If they even go into effect, or at what level they go into effect, they can be absorbed by the supplier, they can be absorbed by the corporation. So I think there's a lot of moving parts, but you know what? I'm sticking with earnings growth is still positive. People still have jobs. There's opportunity for them to switch jobs, and wages are growing. And if wages are growing, people are going to spend. And we heard that from Bank of America this morning.
Oh, well, great. Did you go to the University of Pittsburgh? Where'd you go to college? Was that?
Yeah, I went to University of Pittsburgh. I grew up in Pittsburgh.
I thought.
So I stayed local, and then
did they make the tournament or not? I don't. Honestly, I'm not. Did they make the tournament or no? I don't think so.
Know.
Basketball tournament? I don't think so. I don't think they did. See, I'm a Xavier guy. I got my Xavier pin, so I got to give Xavier a shout out. But good luck to all the March Madness brackets out there.
I won't have adventure, I guess.
One thing, Lindsey, I was playing with numbers. That's what I do. Like only twice this last 75 years has the S&P 500 peaked the month of February. We did peak on February 19th. We had a 10% correction. I guess our base case, it'd be rare, I guess, if that was the peak for the year. I still think there's some better times coming. One thing we like to talk about a lot, and I know you did with Joe and talked about it, the productivity that we've been seeing is a positive development. Kind of layer in inflation and productivity. How you see those two things? Those are things we talk about a lot on this podcast that I think I'd love your take on.
Yeah, so productivity has been on the rise. I know the latest reading was slightly softer than the above 2% range that we saw, but I think that there's opportunity for that to increase, obviously, with the developments of technology and AI. And I think that what we saw at different periods of time in history is that productivity has played an important role in earnings growth and economic growth in particular. And what we did see is, in the 90s in particular, I've been looking back at the 90s in comparison to the period that we're in, we saw productivity was above 2% in the decade of the 90s, but it really took off in the second half of the decade as technology changes really sort of kind of became ingrained into the everyday lives of individuals and in businesses and things like that. And so I think what we're seeing now is we're seeing good increases in productivity, again, above 2%. But there's a potential, if we see that tick even higher in the latter part of the year, the important thing about productivity gains is hopefully those are passed on to consumers in the term of wages, right? And wage growth like I already talked about, there's significant correlation between wage growth and spending, consumer spending. And so if wages are growing, especially above inflation in a real wage growth environment, we can really see significant economic growth, because as you guys know, the consumer is 2/3 of the economy and very important aspect of the economy that we're keeping a close eye on in the near term.
Yeah, no, we've been in the camp that, productivity growth is running above trend. And with that, you can have, to your point, right, strong wage growth, but crucially with low inflation. And some of the companies never pass all the productivity gains on to workers, but which means some of it also goes into margin expansion. And that matters for earnings, going back to something you were saying, connecting it back to that. But, to that point, I was just looking at, last night, I sent out some data to our advisors and our team about industrial production, right? Coming to the productivity piece, high-tech equipment spending was up, actually high-tech equipment production, not spending, production. So they're making all this stuff, semiconductor chips, things like that, EV batteries. That was up 26% annualized over the last 3 months. Wow. It's running well above trend, right? So that's the stuff you want to see for that productivity piece to continue above trend. I'm curious what data you're looking at right now to determine. I mean, it sounds like you're in the same camp as us. We don't think there's a recession. You mentioned layoffs are low, things like that. I'm curious what you look at to see, where we are in terms of economic growth.
Yeah, so I mean, I mentioned a handful of them. I always start with earnings because that's just my upbringing, I guess. But then I go into the labor market, and I know that payrolls, and I know that payroll and unemployment can be a lagging indicator and has historically been viewed that way. But still, you can't deny that unemployment is at 4.1%. It's, historically low levels. I also believe that from a consumer perspective, you got to look at the job openings report. And what you're seeing there is 7.7 million jobs available. When the consumer has job opportunity, it makes them a little more optimistic. I know the consumer has been very pessimistic as of late, according to some surveys.
They were pessimistic in 2022 and 2023 too, right?
Yeah, exactly. So I'm always looking at the consumer. But I look at wages because, again, I talked through that already. Some of the other things too is I like to look at the bond market too. What's the bond market telling us about the economic outlook? Because those are folks that we're the optimists in the room, following the equity market primarily. But the bond investors, fixed income investors, they get paid to worry, right? So they're always the ones looking for around the corner, looking for what shoe's going to drop next. And when inflation has been a major key a major driver for the market over the last several years, and obviously driving Fed monetary policy, which we're going to learn a lot more about tonight. But when I look at in the inflation indicators, the break evens, the 5 years, the 10-year forward-looking indicators in the bond market, inflation expectations have fallen since January. And that compares to consumer expectations are taking off, which is concerning. So there's that difference there. And I think the difference is that the consumer really is telling us they can't really withstand more price increases without greater wage increases. And so I think that's the sentiment that we're seeing. But also further looking at bond spreads, I know they ticked up a little bit, but they're still very low versus historical averages. And then also, if we have this major growth scare, if we think that there's really going to be a massive slowdown, how come the expectation for rate cuts hasn't really moved? I mean, we were at one point, there was an expectation for one cut. The Fed's been at 2. I kind of don't think they're going to change their stance on that today.
And if the policy is still meaningfully restrictive, even if they cut 2 times, it's still presumably still restrictive.
Exactly. So that's kind of where I'm looking. And of course, I look at some of the leading indicators too. There's a handful of them that are still in positive territory versus, like you mentioned, industrial production, some of the manufacturing stuff. It's questionable. There's been some pull forward there. But what we have been seeing before the tariff stuff started happening is you were seeing this is supposed to be the year that manufacturing was supposed to heal and start improving, right?
Now, I asked Ryan this question yesterday, so I'll ask you the same thing. Scale of 0 to 10. And 0 being you're not worried at all. 10 me, Ryan, you want to 10. 10 is Harry Dent level of
Harry Dent level worry is level 10. That's our joke.
How worried are you? Economy, markets, you can take it. You can separate it if you want, put it together. It's up to you.
So I'm like a 6 because so a little over neutral, and not like super optimistic. Here's the thing, I do worry about the consumer because when you look at the consumer, I just talked to, they are really worried about prices, right? And they are seeing wage growth and there are job opportunities. The flip side to that is companies haven't been hiring either, right? They say there are all these worker shortages, but they're also not hiring. So there's a little bit of uncertainty there. And so I think we do need to be mindful of that, because the longer this uncertainty about tariffs and where prices are actually going to go lingers, the consumer could become more anchored to higher inflation. It becomes a self-fulfilling prophecy, right? So I do look at that, but that's really the main place where my concern is. Offsetting that, though, the reason I come down, I'm not further up the scale in terms of worry, is because look, one of the things, what could go right is the question we need to ask ourselves, right? There's so much worry and uncertainty in the market about tariffs and the negative impacts of tariffs. But it's almost like we've forgotten. I mean, you see the market pop on days like the days in the past where Trump has like kind of pulled back his rhetoric and his stance on tariffs. You see the market pop then. So to me, it tells me that that side of the coin hasn't really been baked into the markets. Also, we can't forget there still are pro-growth policies that are key components of the Trump administration. The focus has obviously been on the harder side of things, which has been tariffs and immigration and things like this, Border Patrol. But the Tax Cuts and Job Act is currently working its way through the system. For whatever you think about DOGE, they are working on deregulation. I think we should be hearing a little more about that in the coming weeks. And so week or month or something like that. So there are other things, like these policies have not been completely forgotten and they're not going to be like not addressed. So, I just think we need clarity, and I think you just got to stick to the facts, facts versus feelings. Let's get all off the feelings and into the facts.
It is amazing how quick this goes. We've got only a couple minutes. I've got one job to make sure we stay on time. It's like our friend Neil Dudd at RenMax said. He's like, when President Trump won, we expected deregulation, taxes, and tariffs in that order. It hasn't been in that order, is what's kind of upset the apple cart a little bit. Is James around? Can you wave and get him on the screen, or is James not in the same room as you? Where is he?
No? Let me slack him, see if he'll come in here.
He can say hi for a second. So we do have to stop in a couple minutes. I mean, for a let's say a little girl, 13-year-old girl who likes stock market, what can she do in the world of finance, you think, to be successful like yourself, Lindsey? And maybe James will come say hi too.
I think you just gotta read as much as you can and try to learn as much as you can, but then also meet people in the industry and talk to them, because there's, like, we both agree that there's not always a straight line. Come on in, James. There's not always a straight line path. And
1 second, James. I want you to say hi in a second. Let Lindsey answer this. We're going to sign off.
So there's just not always a straight line path. So I think it's all about meeting people, learning about the different opportunities that are in the industry, because it's not always what you think or see or have heard. There's a lot of different things you can do in this industry.
Love it. Well, this is awesome. James still there? Is he still there? James, you got 30 seconds. Tell us why someone should listen to what Lindsey's up to, what you're up to over at Clearnomics. We do have to end this, but good to say hi, my friend. What's up with Clearnomics?
Yeah, great to see you, Ryan. Yeah, great to see you, everyone. At
30 seconds, though, James. I'm cutting you off, man. So let's hear it. The elevator pitch. Let's hear it.
Yeah. I mean, Lindsey is one of the best in the industry, as you guys know. I mean, she joins a fantastic group here on this panel. We're just here to help advisors talk about what's happening in the markets, to complement a lot of the fantastic research that you put out at Carson. So whatever we can do to help, we're here.
Awesome.
Fantastic.
That was great. Well, thanks, James. I said it was a great hire, and I think you guys are going to do awesome together and build the team. So, Lindsey, thank you so much for joining us. You set the bar very high. We've got 3 more guests coming here over the course of 2 hours on Facts versus Feelings.
You know what I have, Ryan?
History Month. Oh, Sonu got a milkshake. I need to order a milkshake.
I got my milkshake.
Lindsey. When we do live streams, we get milkshakes. I'm behind on that. But Lindsey, any final words, and then we're gonna go to a commercial.
No, thank you for doing this. This is so fun. You raising women's voices in the industry, and I love that. I'm glad that you thought of me. This is fun.
Absolutely.
Thank you for coming up.
Lindsey, best of luck with everything. Reach out if we can help. We're fans, and good luck with the new gig, as they say. But Tori, we are done. We got a 5-minute break. Let's go to the commercials. Take care, Lindsey. Thank you.
Bye, Lindsey.
See ya. Thank you.
Did we keep it on time?
Oh, we're back already. We've got a little extra time with Debbie.
That's great. Perfect person to have some extra time with.
Yes, you made it, Debbie. How you doing?
I'm great. How are you guys doing?
Good. Nice to see you, Debbie.
So far, so good. The first one down with Lindsey, and now we're really excited, Debbie, because we started a tad early, which is awesome. We've got a little extra time. We got about 28 minutes, and it's a hard 28 minutes, or we get in trouble. So you know how this works. First off, who do you have in March Madness? Do you get into March Madness, Debbie? I mean, what are we thinking?
Before I hop into March Madness, sort of interesting that you're talking to me about March Madness, but before I hop into March Madness, I want to do a call out to Clearnomics and Lindsey and James. So we've been using Clearnomics for a while here in our office, and we are huge fans. I've written a bunch of articles on Clearnomics.
Nice.
We have their chart book coming in every single morning to the office. We use their videos. So they've done some really nice work. And so anyway, I just want to do a shout out to them.
Fantastic.
No, that is awesome. That's great. Yeah, I've known James for a long time, so I was excited when Lindsey joined up. All right, so let's start having some fun. Debbie, you know how it is. We like titles around here and everything, but let's go with your title. You kind of have I don't know if it's a new job, but maybe a new boss. I don't know. I mean, you know what I mean. Maybe a new boss. Talk to us a little bit about
that Burt White guy.
Yeah, Burt White guy. We'd be nice to him. He might be watching. We'd be nice. I don't know. Although I think you can say whatever you want to Burt. We have to say yes, sir. You probably can push back a little more.
It'd be nice to him after all this time.
Yeah, Anyway, so talk to us a little bit about your career and kind of how you've always been with Carson, but what you're up to now to help advisors, and we're going to get into all the other stuff. But we're just excited you're here, Debbie.
Oh, thank you. Yeah, I mean, real quick, because I feel like some of that stuff's boring, but I don't know. Yeah, I mean, I've been doing this now for almost 30 years, and I became wholly owned with Carson as of January 1st. So I built the practice. We have 10 people here in Franklin Lakes. And, we're basically $400 million, although the market's hurt that a little bit over the last couple of weeks. And then, I became wholly owned. And as of January 1st, then I'm also chief tax strategist. And I'm also, a CPA and a retired attorney.
Wow, that's great.
That's all?
So it's been amazing listening to you just over the last few months since you've taken on this role at Carson and talk about taxes, and I think our investment team especially, I'm biased, but I'd like to think we think a lot about taxes too, and so it's really exciting to have you leading this effort at Carson and talking about tax alpha. Right, tax alpha is different from the alpha, say Ryan and me and Barry and Grant.
Sonu, we have an intro for Debbie. We didn't use it.
We did.
We want to use your intro. Sorry, we get so excited to talk. Tori, I'm sorry. Let's just play the intro now.
Yes.
I want Debbie to have the proper intro. We should have given her. We screwed up already. Here's your intro, Debbie. Sorry. Maybe not. Well.
Oh, the intro already went.
Oh, it did. Oh,
it did. We weren't paying attention.
We're just screwed up all over the place. All right, never mind. Sorry. Anyway.
But
Yeah,
wait,
where were we? I'm sorry, I jumped in.
Tax alpha. Debbie, why do you think tax alpha is important? How do you think what do you think advisors can do to generate tax alpha, which is different from investment alpha, the way we think about it, right?
Yeah, I mean, there's so much, Sonu. Like, that's a total loaded question, right? And ironically, I just got off the phone with the guys from AQR, which, just
good friends.
Yeah, I mean, there's just so much opportunity there, and that's just one little sliver, right? So I think taking a step back, right, is, when we think about wealth, I think about wealth as a 3-lane highway. Okay. And even Bert, by the way, now is talking about the 3-lane highway. So he's starting to steal my stuff. Ryan, does he steal your stuff? Because he's stealing my stuff.
I mean, there's an
old question right there.
Yeah, no, there's an old saying I've always used. If you take it from one person, it's called stealing. But if you take it from everyone, it's called research. I think Bert does a lot of research.
I hope he doesn't listen to this.
Sorry.
This is gonna be 25 minutes of what do they call it when you talk trash about somebody in front of them?
Roast.
What do they call
Roast.
Yeah,
Roast.
it's been a 25-minute roast on Bert Way.
No.
So anyway, basically the way I think about wealth is the 3-lane highway. The first lane is investment management, which is the area that you guys really focus on and do such a great job in. And it's not to say that you're not thinking about other areas, right? But your main focus is investment management.
Sure.
Then the middle lane or the second lane is financial planning. And, we know people who are, working in planning, right? And I think of planning, by the way, just aside, in 2 ways, is accumulation and distribution, right? And I think the planning profession has not done a good job in talking about the distribution part of it. They've done a good job in the accumulation part of it, right? Okay. So one of the things I'm trying to bring attention to is the distribution part, which of course a lot of taxes play in there, right? And then the third lane is family tax planning. And I call it family tax planning because it looks different for everybody. And so even if Sonu and Ryan had the same exact balance sheets, your family tax plan would look different. Even if your investment tolerance was the same and we put you in certain Carson models or whatever, Sonu, and I don't know much about your personal situations, right? But Sonu's married, he's got 4 kids, and he wants to take care of
twins. I have 8-year-old twins, that's it.
Boys. Okay. So Sonu's like, well, let me tell you about my personal situation. Right? So
I can get a financial plan right here. Right?
Yeah, exactly. It's a 5-minute plan. It's a 5-minute plan. All right. So Sonu's like, hey, I need to take care of my wife and kids. But Ryan's a player, right? He's out there. He's got a lot of girlfriends. He's got a lot of stuff going on, right? So Ryan's tax plan. Yeah, Ryan's tax plan. Hopefully Bert and your wife are not listening to this, right? But Ryan's tax plan is going to look completely different. And so I call it family tax plan because it's highly customized. It's not really easily scalable, but that's what makes you so valuable to the client, right? Because it's not so plug and play. So anyway, so taxes then really come into play in the distribution planning part, but really that third lane, that family tax planning lane.
I think that's so important, the distribution piece. But to your point, I don't think a lot of people think about that because when they first got, we are in the investment side, right? We are thinking about accumulation by the nature of it. By definition, we think about accumulating. How can we grow your portfolio, right? But at some point, people have to take out money. And then when you take out money, you have to pay the Fed, you pay Uncle Sam, right? And I feel like what you're doing is how do we keep more of that?
Yeah. And, it's interesting, Sonu, because for most of our clients, their largest expense in retirement will be taxes.
Wow.
Right? And if you go, when you sit during the planning process, they'll say, oh, I want to take a trip to Europe every other year. Can you bake that in? Oh, I want to buy a new car every 7 years. Can you bake that in? Right? Nobody's like, hey, taxes are going to be my largest expense in retirement. What are you going to do about that? But that's the truth. Absent chronic illness or long-term care expense, absent something like that, taxes are going to be your largest expense. So why aren't we being proactive and trying to cut that bill down by millions of dollars?
Right. I have never heard that. That's hitting home right as I speak. That's
particularly Sonu, if you've got a large retirement account, which so many people have these days, right? Because here's what's happened.
Like an IRA or a 401k, right?
Right. They've done such a good job with the investment management part, right? So you guys have done your job in the first lane. And what you've done is built these huge balances with a market that's cooperating. And by the way, with people living longer than ever before, they've got these huge balances. And you got to, like you're saying, you got to eventually spend down that balance one way or another, or try to leave it to the next generation. And whenever you try to do anything like that, then taxes come into play. And it's becoming more important today than ever before, particularly with this bull market and these huge balances that people have accumulated that even 10 years ago you didn't see.
Right. So
Right.
it's a good problem to have. You have a large balance, problem, but there is a problem in terms of distribution and taking money.
There's absolutely a problem. And that's, by the way, and I know Ryan's like chomping at the bit to get to the next thing, but Sonu and I started to nerd out a little bit on this. But and that's also, Sonu, the interesting part about it is that when we walk in the room, when a Carson advisor walks in the room, for some of these clients or prospects, this is the first time that anybody's had this conversation with them.
Mm-hmm.
Yeah.
Well, I'll say this. We have a divided country. We know that, right? We just talked with Lindsey a little bit ago about some of the inflation data. If you kind of lean a little left, you think inflation is going to be higher, lean a little right, maybe not as high. It's the world we live in. I think one place everyone agrees is we don't want to pay a bunch of taxes if we can help it. I think that's where, no matter what happens in Washington, I think the conversation we're having is important. And one more thing, a little personal note. My dog Mabel, she's 103, I think, pound. She lost some weight, gained some weight. Great Dane. She's had pneumonia for like over a month. Last night, she got really, really sick. And my wife and Emily and I were like, we better take her to like a 24-hour vet. We did. She is at the vet now getting all this medicine. This pneumonia won't go away. $2,700. You talk about an unexpected charge. I mean, I know what happens is life, but it's like, oh my goodness, I need like dog insurance. I even think Carson offers that. I probably should have bought that. But anyway, so things happen like that, and that's
maybe listening here. So
I'm more ranting. I don't even have a question really. I'm just ranting about this, but hopefully my doggie's okay. Let's talk a little more about that. How do you help clients, or how can you help clients with those unexpected bills? I mean, do you say let's save a certain amount, or do something every month? I mean, because these big, and I know $2,700. Believe me, it's a poke in the eye, but there's bigger bills that people have that just my brother, he got cancer last year. Trust me, they're dealing with incredible bills they didn't see coming. How can you help someone with things like that?
Yeah. And so it's interesting because I believe that there should be 5 key components of a retirement plan. And component number 3, item 3, is you've got to be prepared for large expenses. Some of them are planned and some of them are unplanned, right? So planned expenses are a daughter's wedding in a year, or trying to buy a second home, right? But then there's unplanned large expenses. And
daughter's wedding tomorrow.
Yeah, sometime, right?
Yeah.
But that could be, unfortunately, a natural disaster. That could be a sickness, right? So you have unplanned large expenses and planned large expenses. And what you need then is a liquidity bucket, a plan B is what I call it. And everybody should have a plan B. And maybe several plan Bs. So that's how you address it, Ryan.
Okay.
One thing on that, like everyone, like I usually don't talk about finance and investments when I'm at, with friends and things like that, because like it's too, I can get into jargon and spreads and things like that, but nobody wants to listen to me on that stuff, right? But I think there's a general assumption that, Sonu's an investment, so there's no need of, like, he can do his financial plan. But I actually have an advisor who has been, like ever since I came to Carson, that's when I've had an advisor. And shout out to Grant Nealand, who's my, me and my wife, we work with them closely. And it's been, huge. It's been massive, even though we usually don't talk about, it's weird when we get to the investment piece, because, all of our money, my wife and I, our money is in the models Ryan and I manage. So we don't talk about that, but that's like a small piece of the conversation. And just getting my wife and I on the same page has been, like, I think, a game changer, to be honest. And I feel like that's the value you all bring as advisors to the table, right? In addition to taxes and thinking about everything you're just saying.
Yeah. Yes.
So I was going to ask do you have an advisor? I was going to cheekily ask, or do you do your own?
That's a good one. So just as an aside, by the way, we're right outside the New York City. We have clients that work on Wall Street, and they are liaison portfolio managers. They're hedge fund managers. Right. They have MBAs from Chicago, but they might know one sliver of finance or the investment universe, right? So Sonu, like, more than a sliver, of course, right? But all of this, But then there's all of this that you're not aware of. And also then there's an accountability component, right? You talk about you and your wife being on the same page. There's a whole behavioral finance aspect to it, right? Is holding you accountable, making sure that you and your wife are on the same page. And you could have, all the PhDs in the world, and your wife could, but that accountability component or helping you with areas that you're not an expert in, that can be priceless. So yeah, like we have clients that work on Wall Street, and we are hugely valued for some of the work that we do for them. But that's a long way of trying to avoid, no, I do not have a financial advisor. But no, I don't. I do work with my husband. And so there is a lot of accountability there going back and forth between the two of us. But yeah.
That was just a cheeky question. So cover the markets, a little bit. Like we've had a lot of volatility, and you sent out this really cool note to advisors about like what can be done sort of adjacent to market volatility, what they can do without like selling everything and going home and just sitting in cash, right? Because that tends to be an instinct for a lot of people when things get scary. But you're like, wait a minute, there are so many other things that you can do when you're faced with market volatility. Talk about that.
I love that. So I call it making lemonade out of the lemons. And how I also describe it to people, and you, Sonu, will appreciate this, and Ryan, is I say capital doesn't evaporate. It just gets redistributed, right? Yep. And then the other thing I say to them is, let's do what the smart people do. There's always a way to make money. We just need to figure out what it is. Through every market crisis, right? There are always people that were able to capitalize it and profit from it. And so I want to give clients an opportunity to sort of take back control, not feel like victims, not feel like all of this is happening to them. So when they see the markets going down, I'm like, there are opportunities here, and let's talk about those opportunities. So the piece was 9 strategies for a volatile market. So we talk about tax loss trading. We talk about funding trusts, right? Or doing gifting, right? So the best time to have your business valuation, if you're thinking about, putting your business into a SLAT, right? Or an LLC, is when the market's down, when the business has gotten devalued a little bit. And I'll let you guys in on a little bit secret, and our listeners, is I had my business appraised in the middle of 2022. Okay. Yeah. Exactly. Right. Exactly. Okay. There's an opportunity. And when you do these things, Roth conversions. So you guys will appreciate this. We did Roth conversions. Listen to these dates: in June of 2022, in October of 2022, and in January of 2023, when we had a new calendar year. Okay. And if you remember in 2023, in January, they were calling technology as being dead. Remember that? They're saying out of technology, into dividend, technology is over. We did not agree with them. My husband has a technology background. He was a developer, software sales, and in technology. So we did not agree with them. That was not our house view. I know that was not your house view. So in January of 2023, breaking all of the rules of thumb, because you're not supposed to do Roth conversions in the beginning of the year, right? Like all those stupid rules of thumb. In January, we went back after doing conversions in 2022, and we said, we want to convert before the market bounces back, because we were bullish, just like you guys were. And so in January of 2023, boom, new year, new calendar year, new tax year. And we went back and did conversions for these clients. Even though we were doing conversions in December of 2022, year-end conversions, and in October, went back in January. Those accounts are up double and triple digits, right? Our clients think we're geniuses.
And so it's growing tax-free because it's in Roth now.
Yeah. And we targeted the technology. So now those stocks, those technology stocks, are in their Roth IRAs from 3 years ago. So this is where, the clients then are so appreciative of us being proactive, us being creative, and looking, not all 9 strategies you're going to use for every client, every pullback, but you're like, hey, Sonu, we were talking about, you possibly selling your business. This could be a time to do the gifting. This could be a time to set up your LLC. This could be a time to get the business appraisal. Like, the Roth conversions. You've got this $2 million IRA, and you can even do it like somebody's working. They're in a high tax bracket, right? You're like, hey, Debbie, I'm in a high tax bracket. Well, I did analysis. If you do Roth conversions, even if someone's in a higher tax bracket and the market's down 10 or 20%, the market bounces back just to break even. You're basically doing those Roth conversions at a discounted tax rate.
Sure.
Right? And that's even just the market breaking to even, which it did very quickly, and then has gone double digits and triple digits beyond that. So that's just some example of it.
Don't give everything away. They have to come to Carson first.
Well, that's what we're going to
talk. Debbie's secrets.
Yeah, we've got about 10 minutes. I was wanting to talk a little bit about that. Well, 10 minutes ago, this is Women's History Month, Building Community for Women in Finance, a live stream of facts versus feelings. So, Debbie, again, we have about 10 minutes or so. How are some ways that Carson has helped empower you? Yeah.
So I was thinking about that this morning. And so first of all, I believe that a fish is healthy from the head down. Okay. With Bert as the CEO, building this amazing executive management team with a lot of very strong, very capable women. So that has been super exciting, because when you read all the studies about women, women in business, just women trying to make it in the professional world, whether it's finance or something else, they talk about mentorship, they talk about allyship. And at the end of the day, if you don't have women in leadership roles, the world is not going to change. You're not going to feel supported as a woman, as part of the team. You're just not. You want somebody to emulate. You want somebody who's up there as an example. And so, number one, we're seeing women coming to Carson in leadership positions that I admire, I respect, and even including myself being chief tax strategist. So that's one thing that I love to see. There is a women study group. I actually joined it, I think, a week or two ago. And so that's great to see the community of women. There's, the women's newsletter, and then there's the women's conference. I'm going to it next month. And it's called Represent. And so that's really exciting. And so you see some things that are sort of like on paper. And you're like, oh yeah, like, yes, they're checking the box there. They're checking the box there. Right. But I will tell you beyond that, I feel like the community there is a very merit-based community, and women who are strong and women who want to be great advisors or great part of Carson are going to absolutely have that opportunity. And I know that. So those are some thoughts.
And that's an aspect too, like women have a lot more wealth now than in the past, and are making decisions about their wealth, right? So, and I imagine there is some affinity too, like people want to talk to people like them. Right. However it is what it is. Right. I'm curious how you think about that stuff as well.
Yeah. So $51 trillion is going to be inherited by women over the next 2 decades. Right. $51 trillion. And they're growing their wealth at twice the rate of men, but they're still investing less than men. Less of them are showing up to advisor meetings than the men. Like, there is data behind all of that. And so one of the things they talk about is having an office that has women advisors in it, so that when you are reaching out to your women clients, they are meeting maybe with a woman as part of the team. And so again, sometimes it's just so simple as that. Like, we can have fancy newsletters and things that have pink all over them, right? But at the end of the day, having a woman advisor or having a woman like on the team as part of your advisory team, that speaks volumes. And so I think there is a huge demographic shift going on here. We know that all the data is there. And again, I love that Carson's out there in front being super supportive of that. But it's real. I mean, we have women more and more that are hiring us because we are women-led. Specifically, they are like, we want a woman. Our branch here is 70% women, which is very unusual. Those numbers are basically backwards of what you'd see in any other traditional office. And of course, a woman founder. And so what we do is different. So our communications, I tell you, I think are exceptionally strong. Women's History Month. We have a lot of celebration for Women's History Month and a lot of work we're doing now. And then also in October for Breast Cancer Awareness Month. We have women wellness events. Like, there's a lot of ways that we are trying to communicate differently and support women on their journeys.
Well, I want to give a shout out to Terry Shepard, our president here at Carson. I know she's stepping away soon to do some things with her family, but she's been the president at Carson for a long, long time. And Terry's awesome. So congrats on a great career and just making Carson better, but our entire industry better to Terry. So we've got a couple.
Thank you to Terry. Yes.
Yeah, we've got a few more minutes. You know, you kind of went this route. I want to go a little more though. We have a lot of financial advisors that listen to this live stream, that will listen to this podcast. When it plays a little bit later. Why would you've been around? You've seen a lot of places. I'm sure a lot of places tried to recruit you before you became a fully owned office. So I'm trying to say, why Carson? Why should a financial advisor out there come to Carson? Now, this is male or female. We're just opening the whole spigot now. Why should anybody come to Carson to be part of our community?
By the way, they're still trying to recruit me, Ryan. I got something this morning.
Well,
okay.
You're loved. What can you say? There you go.
I mean, they're clearly not checking LinkedIn, right? Okay. Yeah. So I want to pretend that I'm interested in going elsewhere because I need Bert to listen to this and get nervous. Okay. So, but the truth of it is, why should any advisor come to Carson? First of all, and I know I keep talking about this, I don't think there's a better CEO in the industry. Okay. I truly believe that. Okay. I think Bert White is such a visionary. There's nobody smarter in the room. He gets it. He has got a vision. I can't even put it into words. Everybody's playing checkers. He's playing chess. He's 10 steps ahead. And so, I do believe having a strong leadership team, but having a strong leader with a vision is so critical. So I think that's super important. And I think what we're doing here in the investment department with you guys, and then what we have going on with tax and sort of wealth strategies overall, we are building something that is literally going to be best of breed in the industry. And we're not going to stop until it is. And so, we have Bert's support. We have the executive management team support. I love how all of us are working together, because it's not just the first lane, you, Sonu and Ryan doing investments, and then me over here doing tax, right? It's all of this working together. And that's what we're doing over at Carson. And it is wildly exciting. And it is best of breed. So if you say, Debbie, what are 2 good reasons? I would tell you the best leadership team in the industry. And I would tell you the way that we are building out tax planning and investments, again, is and will be industry leading, and will make you, the advisors, tons of money, will help you close larger clients, will help you build wallet share, will help you service clients in the way they want to be serviced, but they're not getting serviced. And we're doing all of that.
Yeah, to that point, this evening, I think we have a meeting together to talk about, like the folks from planning, investments, and Debbie too, to talk about, how we can present something to a large prospect.
Yeah,
right? Exactly to what Debbie just spoke about. How much time do we have, Ryan?
Yeah, about 2 minutes. Yeah, not much. It goes fast.
I have one question. You brought this up. That's what got me thinking about it. Why are women, I don't even know this is true, but it seems like, why are women more conservative with investments? And maybe that's not a bad thing, because maybe they panic less than men. That could be the case. Maybe like, oh no, this is happening, let's sell. We have to act. Sometimes it's better not to act, but I'm curious why, if you have any thoughts on that.
So no, I do. I mean, I have a ton of thoughts on women in investing, women in the industry, because I've lived this for almost 30 years now, right? And I will tell you, I know we have less than 2 minutes, but really quick is, from a very young age, women are not educated, and our culture does not encourage women to be involved in money, to be involved in finance at a very young age. Even think about little Timmy and little Susie. Timmy, what do you want to be when you grow up? I want to make a ton of money and I want to run a big company. Susie, what do you want to be when you grow up? I want to make a ton of money. I want to run a big company. And you're like, Susie, that's like, you're a little embarrassed that Susie's talking like that. And so ironically, from a very young age, boys becoming men are encouraged to think, hey, money, math, finance, getting a job, and girls are sent mixed messages. Okay. Even if they have the capability, they're sent very mixed messages from society. And I do believe that that's a big part of it. And then you fast forward and you've got men doing the meetings with the financial advisor, who happens to be a guy in 80 to 90%. And the woman says, Jim's got it handled. My husband's got it handled. And so it becomes this sort of ecosystem, self-reinforcing. And it's a shame because we also know that 90% of women will be managing their own wealth someday. 90%. So we should be training every little girl to take ownership of her life, to feel comfortable with math, to feel comfortable with finance, even if she's going to be a stay-at-home mom, okay? But we should encourage these young girls and young women to take agency because they're going to be managing their money someday. Eventually, they all will be. So it is actually sad, and it's one of the reasons you hear me out there so aggressively having these conversations, writing these articles. I will say I have 2 daughters. One of them's an investment banker. It's got her master's in finance from Hopkins. And the other one works here in the business with me, and you guys have met her. So at least with my 2 girls, I feel like I started off okay. But I'd love us to spread this to all women out there, right?
Love it. That's so awesome.
No, absolutely. Well, Debbie Taylor, the Chief Tax Strategist at Carson Group, this was an excellent, awesome conversation. And by the way, you reached out to us, I don't know, 6 weeks ago, said, hey, let's do something for
this whole thing
Women's
came
History
out of
Month.
that.
This whole thing came from one email from you. So thank you for pushing us to do it. And believe me, we jumped all over it. We love doing stuff like this. So I think it's just another small way of showing the way Carson works. Someone says, let's do something. We just do it, right? And not always going to work, but we're willing to take chances, willing to take risks to make our financial advisors and our partners help them grow, help their clients. And as I think Debbie gave one of the best, 90-second commercials ever for why, if you're a financial advisor, you might want to come over and join us and learn a little bit more. But we have to go. Debbie, thank you so much. Have fun with talking to Sonu in a couple hours, I guess. And I hope to see you very soon. Maybe, Omaha, maybe in May at Partner Summit, probably. So looking forward to that. But with all of that, Tori, we're done. Let's play the commercials. Thanks, everybody. We'll be back with Jess Menton very, very soon from Bloomberg.
At Carson, we're always innovating and iterating to make our offering more complete and help advisors find their freedom. And one of the new enhancements we're most excited about is our wealth management platform, which has evolved to help our advisors deliver a more personalized investment and planning experience to their clients at scale. Our investment platform and research team have grown significantly, and we're providing advisors with more flexibility to manage their investment program on their terms. We have intentionally built a wide-ranging but highly curated mix of equity, fixed income, and alternative products and managed portfolios, along with the tools, content, to power your management style and story. And we've expanded our planning offering to help our partners cover tax planning, estate planning, trusts, insurance, group retirement plans, and more. And that's just some of the ways Carson helps advisors find their freedom. Learn more at carsongroup.com.
And we are back. We've reached a halfway point, Sonu. It's going fast, but we are so excited to be joined by our good friend Jeff Menton. Jeff, where did that come from? Jeff, I am sorry. I don't know where that came from.
It's been a long few weeks, right?
It's an hour now.
I felt like 2 weeks ago, every day felt like Friday. But anyway, Jess Menton, apologies. I guess you're live from Bloomberg, right? Which room are you in there? Have I been in that room? Where are you?
So I'm not at my desk right now. We have a lot of fancy rooms, but I couldn't figure out how to get this to zoom in any closer, so I look a little far away, but hopefully you can hear me, so it all works out.
Yeah, and we see some Bloomberg stuff. There's my office in the background, too.
In case people didn't believe you really... In case we didn't believe you really worked at Bloomberg, it's really there. This is neat. So Jess, we're excited. We've already had conversations about the markets. We talk about taxes, and I love what you do. You talk about markets, but also you live in the world of media, and I do a lot of media, and Sonu does a lot of media. So I thought this would be a really fun conversation for the next 25 minutes or so. But let's just start. We live in a world of compliance. We like titles and things. What's your title over Bloomberg, and what kind of do you do all day? Because I know you do a ton, but what do you do all day?
So I do have a few different roles. So I'm the deputy team leader for the U.S. equities team. And so that basically means I'm helping manage the coverage that comes off the U.S. stocks desk. And then I'm also a senior reporter for the same team. So that means I'm also doing more of the enterprise, kind of big feature reporting, sort of the bigger takeaways from what's happening when you connect the dots across the equity market, whether you're looking at obviously technicals, like I know you watch very closely, Ryan, as well as positioning, derivatives, what's going on with macro, micro, and then pretty much everything in between, and then basically telling kind of these are the bigger stories of the week, as well as if when we get toward the end of the quarter or annually. So it kind of just depends on the size and scope. And obviously there's always big moments in the market, but clearly we're at a crucial inflection point right now.
No,
I'm curious. I see the Bloomberg terminal keyboard in front of you.
Yeah.
Yes.
What was the last chart you looked at? I'm sure the Bloomberg terminal, like, it's in front of you. I'm curious.
So I have, right. So we're lucky as reporters, we have this G function where we can go and save a lot of our charts, and I can go and kind of quickly and update different things. I was actually just looking at the cost of hedging for the SPY. So obviously the ETF that tracks the S&P 500. And so that can tell you a lot of like the hedging demand, like how many, and you can do it on different time frames. So you can do it a month out, 2 months out, 3 months out. But what's interesting about that, even though we saw it spike a bit, obviously once we came off of the highs for the S&P 500 a few weeks ago on February 19th, and after we saw a number of the sell-offs, you saw the cost of hedging climbing, but still now it's come down a little bit. So it's not nearly as much as it would have been, say, right after the December meeting for the Federal Reserve. That was on December 18th. And then obviously when the yen carry trade was unwinding in early August. So you're seeing the cost of hedging come in a bit. And a lot of that just has to do whenever I'm talking to sources like Danny Kirsch over at Piper, as well as other people who work in the derivative space. A lot of their clients were already degrossing and had hedges on before what happened with the correction. So that's why you're not really seeing a spike in that yet, as well as the VIX, of course. It's closer to 20 now, but intraday trading earlier this month, we saw it get closer to 30. And usually when I'm talking to people in the derivative space, it gets more costly to put on puts or protection above that. And so sometimes 30 can be that kind of line in the sand and a bit of a ceiling there.
No, love it. I just realized I'm on Bloomberg Radio in a couple hours to close today. So it's a small
Carol
world.
And Tim.
Carol and Tim. Exactly. Carol and Tim. So shout out to them. Always enjoy there. So, I love the idea. We'll talk markets too. We've got time, but I love the idea of careers, right? I know you and I met, I guess I met you. Was it USA Today, right? That's where you were?
So actually, I think we met even before that was at the Wall Street Journal, right? So I worked at the International Business Times. I was covering equities, markets, macro. I pretty much always covered equities, macro, and everything in between. And then I was at the Wall Street Journal for a long time. Then I was at USA Today, did the same role.
Got it.
And then you got recruited to come to Bloomberg. So it all worked out. But so we've known each other for probably at least 10 years.
It's been a minute, but I always enjoy getting to talk with you and everything you've done to help kind of my career. And I love chatting with you on markets. So that's great. Now with Bloomberg, you do some radio, you do some TV, you do some writing. I mean, it feels like you're everywhere, which is awesome. For someone just from a media point of view, is that normal to do everything like that? Because it feels like you're everywhere, which I'm really proud of you when I see you all over the place.
Well, thank you. A lot of it has to do because underneath the Bloomberg umbrella, there are so many different platforms. So predominantly, I'm a print reporter and I'm writing, but because you also have Bloomberg TV under this umbrella and this radio, it's literally on the same floor that I work on. So I can just kind of run over. And you were mentioning Carol Massar, Tim Stenovic, who you're going to be on Bloomberg Radio on Bloomberg Business Week later this afternoon. But there's a lot of times if they're on vacation, they'll pull me in to fill in for them. Or a lot of times, like tomorrow morning, for instance, I have a weekly hit with Tom Keene that I'll do on Thursday mornings. And then occasionally I'll step in and anchor with him if Paul Sweeney's gone. I think I'm with him with Tom Keene next Friday too. So it's fun because I get to, they really bring me in because they value the reporting that I'm doing and the writing and the conversations I'm having, whether it's with hedge fund managers, people that are maybe on the retail side, portfolio managers, and then strategists, and then anything going on with derivatives and technicals. They really want to hear about what are my conversations like, what are people, how are they positioning specifically, because it kind of can help them get some insight into what's going on in the equity markets.
I was looking at a recent piece that you did, maybe the last piece you did, unless it's a new one today. You were writing about profits, and profits are what ultimately matter to markets, right? We're talking about, market volatility and tariffs and things like that. How much is the profit outlook changing, and if so, by how much? And I'm just out of curiosity, how much is it being impacted by, say, tariffs?
What's interesting about this, and I know that y'all cover this so closely too, and of course, Gina Martin Adams, as Ryan knows very well too, she's on the CMT Association board, and she heads up our sell-side research at Bloomberg Intelligence. And so her team, along with Michael Casper, Wendy Song, they monitor this very closely. So what they do on the Bloomberg Intelligence dashboard, so anyone who uses the terminal can go in like BI Go and go to Equities and see what they're looking at. But basically, they pull in the sell-side consensus estimates. And what's interesting about this, despite what's been going on the last few weeks when the S&P 500 was briefly in a correction, obviously the NASDAQ 100 is still in a correction. But if you look at the profit outlook for 2025 as well as 2026, it's still very strong. So it's coming just slightly for this year. It's around 10% growth compared to 13% at the start of the year, but typically investors are looking further out, right? So they're looking to 2026, and that's still at 14%. That's unchanged from what we would have been at the start of the year. What's interesting is the point we're at, because we already got past fourth quarter earnings season for the most part, and at 14% earnings growth year over year for that period. I mean, that was the best quarterly stretch since the final 3 months of 2021. And obviously that was the time period where the world was starting to reopen and we saw some massive profit growth when people, especially companies, were hoarding those cash hoards and putting it back through buybacks and things like that. So what we were looking at more closely was earnings estimate revisions, because that can give you a little bit more of a real-time estimate of as far as what sell side was looking 12 months out for EPS growth. So they've been marking them down for about 22 of the last 23 weeks. But of course, we still have, I mean, earnings season really doesn't kick off until April 11th when JP Morgan reports, as well as other banks. And a lot of things could happen between now and then, as well as, you have that April 2nd reciprocal tariff deadline. And I think a lot of on the sell side strategists, they can't really move the needle a lot. And a lot of companies, even though we saw Delta bring down some of their earnings forecasts, I think a lot of companies, especially different industries, are affected in different ways. Like the Mag 7, for instance, a lot of them don't have that exposure towards Canada or Mexico. It's more so when you're looking at in Asia or China specifically. But then if you're an automaker like Stellantis, you have plants in Mexico that could be more impacted. So I think a lot of these companies are really waiting toward after that deadline to figure out how to guide lower. But then you could also see the song and dance where companies move those estimates and lower the bar to more easily beat those expectations.
Right.
So it's a bit of a conundrum, right?
If they were going to use this as an opportunity for a little bit of sandbagging.
Yeah. And anyone who may have underestimated those types of impacts, a lot of whether they're portfolio managers or other strategists, they're saying, well, if something happens like that and companies end up needing to guide lower ahead of before they put their results out, you could easily see them do that. And then once the reports actually do come out in a couple of months, then you'll see the stock higher, even though you might initially see that lower. So it might not be as, in 2018, even though the height of what was going on with the trade war, there were massive buybacks because of the tax overhaul that got passed at the end of 2017. And then, of course, there was that big sell-off in the final quarter of 2018, especially that December. But it was just a very different Fed and a different cycle when it came to hiking compared to what the economy was doing. And really, you didn't see it show up in earnings growth until a year later. So you saw close to 15% year-over-year earnings growth for the S&P 500 in 2018. It was a little over 1% in 2019. So this could take multiple quarters, but then also the economy is much stronger right now than coming out of COVID than it was during that time. So that's another struggle to where you might still see earnings estimates be more robust than people would be assuming.
Oh, that was great. Again, this is a live stream of Facts versus Feelings with Ryan and Sonu. It is Women's History Month, building community for women in finance. Again, joining by Jess Menton over at Bloomberg. So I know you and I were kicking around the idea of Wednesday being strong. I know you wanted to maybe point it out. I've been talking about it a lot. For whatever reason, Wednesday is wildly strong. And then the problem it's the other 4 days, although we had a pretty strong Friday and Monday recently. Why in the world, you talk to a lot of smart people, not that I'm one of them because I really don't know why, but why in the world is Wednesday so strong this year?
It's funny because I saw y'all had put out kind of this annual outlook that you were looking at for key charts, but this chart wasn't in there. This was something else I noticed that I had covered in recent years because it was the opposite. So sometimes you see things change whenever the markets are more volatile. But what I thought was interesting, because last year you typically saw the dip buying Mondays and Fridays, and now it's the opposite. It's on Wednesdays, to your point. And a lot of that has to do with a lot of traders didn't want to go long into the weekend. So whether it was tariff-related news out of Washington or say DeepSeek that we saw toward the end of January. So you had kind of a multiplier of different events that were going on to where you're starting to see that just happen more so on Wednesdays, maybe even Tuesdays sometimes as well, or Thursdays. And you're even seeing it more stark when it comes to more of the retail traders, because I know a lot of people like to use that as contrarian indicators if you're looking at what are hedge funds doing, institutions versus what retail's doing. And you're still seeing strong buying in retail right now, whereas hedge funds were the ones that were dumping coming into this year. And especially stocks like Tesla, a lot of retail traders are still going in and buying that on the dips.
Ryan does so much of great work on seasonality. And my pet theory, I don't even know if this is true, for why seasonality exists. A lot of it, I started my career in the options market, so there's a little bit of bias there. Options modeling, volatility modeling, basically. And my pet theory with seasonality is a lot of it has to do with options, even things like never shorting dull markets, or the strong seasonality from, say, November to January because of all the holidays and option time needing to catch up with calendar time. I won't get into any more details beyond that, right? But I'm curious, I know you look at this stuff, and how much do the options market drive activity or movements in the overall market, like the S&P 500, for example?
I think it can be crucial, especially with positioning and where we're at the calendar. I know that Ryan watches very closely the presidential cycle, and typically the quarter that we're in now, coming off of the election year, you do tend to see some weakness just because you do tend to see historical, especially the last 2 months of a year, once there's certainty about who's coming into office, and as well as what gridlock or not gridlock will look like in Congress. And so you saw a similar dynamic over the last, especially since the U.S. election in November. But specifically when it comes to the options space, we'll have triple witching this Friday. Of course, it's been one of those things the last few years where sometimes people will make a big deal out of it, but then right, it's triple witching. So when you look at the expiration when it comes to specific single stocks, indexes, as well as ETFs, but sometimes you don't really see a lot of movement on the headline surface for an index. It's more micro and specific stocks related, as well as companies that'll be added to the S&P 500 before trading next Monday. So DoorDash is one of those, as well as Williams-Sonoma. So you'll see a few things like that, but then also sometimes people will point to triple witching, but then when it doesn't end up being a big event, it's usually a reason if there is a lot of volatility, but then if there's not, people will say, well, that wasn't anything. But something specifically I would say toward the end of every quarter is the JP Morgan collar trade. So the ticker symbol on that is JHEQX for those on the terminal or where else they want to look at. And the reason I bring that up is because basically JP Morgan has this basket of stocks in the S&P 500 with options on the index, and it also resets and hedges once a quarter. So it'll be March 31st. That'll be a Monday this year. So the closer we get to that,
everybody knows when that is, right?
Right, exactly. And the reason I bring it up is because there is typically strike prices that are at the call level, which we've been paying more attention to over the last few quarters just because of the nonstop rally the last 2 years in the S&P 500. But then there's a put price. And I did a story about this last week because 55.65 was the put level for this particular trade when you're looking at the collar trade for JP Morgan. And usually during intraday a few times last week, like Monday and Tuesday, for instance, you'd see the S&P 500 briefly break below that, then trade back above. And the reason is the closer it is to those levels, like say if you are basically you have to stay neutral as like an options dealer, you might be forced to have to step in and then start buying. Whereas like if you get too far below that price on the S&P 500, like we would have seen maybe on Thursday or the middle of last week, then you see kind of the S&P exacerbated lower, closer to 5,500, but there's not a ton of puts below the 5,500 level. So it's almost like it kind of served as a floor in a way, but those levels might be more crucial the closer we get to March 31st. But that's something that's come up. Because of course I know Ryan watches the technicals very closely as well, but from the options side of it, there's also other levels there too that options dealers are watching pretty closely. So that 55.65 level has been important.
Explains why round numbers tend to be important too. Which always seems weird. Like, why should a round number be important? But that's where some of these strike prices are for the options market. And just to clarify, this is for compliance reasons. Any of the tickers just mentioned or any of us mentioned, this is not a recommendation to buy or sell any of the stuff. So
more educational.
Right.
So I love the media aspect of this because that's why I want to pick your brain a little bit. Working in the media like you have for most of your career, I assume, who are some mentors and maybe some on-camera personality at Bloomberg that's just kind of funny off the camera if you feel like sharing something? Just some stories here on who you learned from over the years.
Yeah, I've been lucky that I've had a lot of good mentors over the years. I think specifically during my time at Bloomberg, because since I cover technicals pretty closely, I go to a lot of the CMT Association events that Ryan frequents as well.
Yep.
And so I feel like Gina Martin Adams has always been a really good resource. I feel like because she's a CFA as well as a CMT, she's very good and probably one of the best to do it when you start threading together what's happening on both sides as far as her team and what they're watching. And then also on the media side, I would have to say Carol Massar, Tim Stenovic, as well as Alex Steele, and a number of others on the media side who've, anytime I have any questions, and of course, you can't forget Tom Keene, right, who's been here for decades, and and Paul Sweeney as well. So anytime I've been able to anchor with them, co-host anything, they're always they want to hear about what I'm reporting on, but then they've done this for decades, so I'm always able to pick their brain and get any advice. So I always feel like, especially Tom Keene in the mornings, it's funny because before we'll anchor together, he always tells me, let's just have fun. So he obviously values and he wants people to be sharp with the market knowledge, but he also wants people, and especially the audience, to have a good time and really take something away and learn something from what we're talking about.
Tom's obviously a legend. I think one of my first like live interviews was with Pim Fox, probably 20 years ago. Pim's not at Bloomberg anymore, right? Or is he? Or no?
No, he went over to Fox, and I think he might still be there. I'm not 100% sure, but he was a big fixture here at Bloomberg for a long time.
Oh yeah, we were going up the floor 6 and being so nervous and not worried, but just nervous. And then like I'm literally on TV yesterday, and I wear this St. Patrick's Day hat on TV. It's like I'm almost too relaxed now. It's the fine line there. So
like
go ahead, Sonu, jump in.
No, it's like we like to have fun.
We like to have fun.
The market's a serious business. I mean, at some point you try to tell yourself, don't take yourself too seriously here, or you get
right.
But actually, I'm looking at my screens and I see green on the screen, which is nice and pleasant to see after the bout of volatility we've had. And our people, let's talk sentiment. Sentiment's shifted, up and down a lot, right? Right now, I think it's generally negative. But are people you talk to, are they buying the dip here?
So retail traders tend to still be doing it, maybe not as aggressively as they were at the start of the year, but because we've talked about the AAII survey so much in the past, and I know that y'all watch this very closely, especially the bull-bear spread. A number of weeks now, it's been an excessive negative territory, especially even beyond if you were looking at the date since 2022. If you pull it back even further, it's kind of astounding. It's almost like at levels since 2009, which both of those in 2022 and 2009 kind of corresponded with lows in the S&P 500, but also something beyond that. I always look at the fund manager survey from Bank of America that comes out in the middle of each month. So what was interesting to me, and we got a sense of this yesterday. So Michael Hartnett from Bank of America puts this out, and he's one of their chief strategists there. So investors were cutting their holdings of U.S. equities by the most on record. And then also the cash levels, they had the biggest jump in cash allocation since March of 2020. So obviously during the height of COVID, and a lot of times those can be more contrarian indicators. You saw cash levels around highs, say back when the S&P 500 was making its lows for the bull market, or the bear market rather, in the fall of 2022 before the bull run over the last 2 years began. So we're starting to see different signals where they're reaching extremes, but a lot of either technicians or people in the option space, and I'm sure y'all can weigh in on it as well, as far as certain signals stacking up, but like it's almost like the conditions made sense to see a bounce back, but they're not necessarily seeing all of the signals just yet. But I would point out that Goldman Sachs, they get CTA data. So basically these are commodity traders that trading advisors. So basically they look at the underlying markets and they look at the momentum. And basically Brian Garrett, who's over at Goldman Sachs, was telling some of his clients that basically the selling was so far advanced that the shift would be more focused to the upside, but you'd have to see a bigger day there. So that's a corner of the market that I'm keeping an eye on to see whether or not they end up stepping up their buying just because we saw such a stark drawdown in the S&P.
Well, I'll say this. I'm a huge fan of Ed Yardeni, right? Also Tom Lee, for that matter. I remember Tom Lee in March of, 2 years ago, March of 23, got pretty defensive, right? There's always bullish Tom Lee, and he wasn't necessarily then. And Yardeni just cut his forecast into Trump put his kaput. I'm thinking to myself, wow, if some of the biggest bulls are kind of saying, I'm not so sure, maybe that's the flush out. That's one, as anecdotal, I get it, but that's something that's caught my attention. We are doing this before the Fed. And, this people listen to it live, obviously live. People listen to it exactly 1 week from now. So let's just put a big asterisk on there. We don't know what the Fed's going to do, but you obviously follow the Fed closely. How have you thought the Fed's been doing? What's your take on the Fed and what you've heard from people out there?
Well, basically, so I covered obviously Powell during President Trump's first term, as well during that trade war and what was going on with the tax overhaul. I would say specifically for more today, when it comes to those dot plots, since they're quarterly, the median projection during the December, because that's the last time we got the dot plots, was around 3.9 for the end of this year. So obviously they're looking to see how that potentially could adjust, whether or not growth forecasts move lower and the inflation forecasts move higher. But a lot of my sources are thinking that Powell could come back and hedge that, saying, hey, if this is adjusted somehow, this could be adjusted again, depending on how the economy moves. But then beyond even just the rate cutting picture, they're looking at what they're going to signal about the balance sheet, because that's always a big story that goes on in the background that sometimes people might overlook here. And that was something in 2018, especially at the end of 2018, they were paring back the balance sheet, and then they ended up stopping just because of what was going on with the liquidity in the markets and the sell-off. So that's something my sources are watching to hear. What exactly is Powell going to say more about that balance sheet runoff in addition to rate cuts?
Do you think they move in a little bit of and I want to be careful here, because when I say the word, in a stagflationary direction as opposed to predicting stagflation, by moving their growth expectations lower and the inflation expectations higher?
I think that would be, a lot of people may take that when you first get the dots right at 2:00, but I think that's why a lot of it hinges at 2:30, what he ends up saying about his rhetoric, because I think he will use that as a way to explain how they're viewing where the economy is at this point. But then, of course, he always stays pretty tight-lipped and basically emphasizes how the Fed's going to be data dependent. And I would point out too, because I know Ryan was talking about when you're looking at more on the sell side research and what the perma bulls are doing versus the perma bears. I mean, Ed Yardeni, of course, he brought down that target for this year from 7,000 to 6,400. Right. But even I talked to Jeremy Siegel, who's a well-known buy the dip kind of stock bull. And I mean, he would still argue for buying the dip, but I talked to him a few weeks ago before we were in a correction, and he was already kind of calling for a 10% correction as well. So that's rare that you would hear somebody like himself say that too.
Just speaking for our models, I mean, but you'd mentioned like managers that degrossed maybe even before this. We'd done the same thing on our side. Not necessarily we kept our equity overweight, but we moved into more like low volatility stocks. We reduced some high beta stuff in the portfolio. So, but I was curious about, what you're hearing from all these different parts of the market and market actors and investors. It doesn't seem like the signals are clear, whether you want to be more bearish or whether you want to be much more bullish, right? Either way, it's like all the signals really haven't lined up on either side.
They haven't. What's interesting, since the S&P made that more recent low on March 13th, you're seeing the more riskier corners of the market taking off. So like non-profitable tech up nearly 8% since then, the Russell 2000 at more than 3% in that span. Most shorted stocks also up close to 4%. And then obviously in that span, the S&P 500 is only up around close to 2%. So, but it would make sense because those were the more beaten down names. So if you zoom out and see how much they got pummeled, you're starting to see that more risk on in the near term. Whether or not that holds after Powell speaks remains to be seen. So we'll have to wait and see if the more riskier corners pick up even more so or not after he speaks.
Well, that was great. What do you have going on this afternoon with the Powell stuff? You on TV, on radio, writing? What do you do to help the industry?
I'll be
here?
writing. Usually you don't see me on Fed days on radio, TV because I'm typing away. So then I'll be doing all that, and then I'll figure out. I will be on with Tom King tomorrow morning at either 8:50 or 9:50. It remains to be seen, depending on how the lineup's going to work with the show. But I'll be busy typing today.
Well, that's great. We've got like about a minute and a half to go here. I know you've got a hard schedule. We do as well. Jess, we're honored that you took some time to speak with us here at this special live stream to honor Women's History Month. I called you Jeff to start it. Obviously, sorry. I still feel bad. But, like going out, let's have a fun one. You're on air a lot, and you've heard rumors or you've seen people on air. What's like one of the biggest mistakes maybe you've made on air? This, not the end of the world, but you call someone Jeff and the name is Jess. Have you done anything like that where you put your foot in your mouth? Because trust me, we have a podcast. We've done 127 of these. I do it every week, so I'm not judging. Any funny story here on air?
Oh man, I'm trying to think of a more recent one on Bloomberg or not. Luckily, not at Bloomberg yet. I'm trying to think of some stuff I did when I was younger. But I think everyone does it, right? Like it's more of like just how you move on. You make any sort of blunder. So I feel like it's the recovery matters a lot more, because even the best of the best, right? Like I see them sometimes stumble just because they've been on air for a long time. So I think you just got to keep going. And so don't worry, I don't take offense for being called Jeff. So a lot of people call me Jen on accident. It happens.
Yeah. And whoever Jeff Menton is, I'm sure there's one out there. Hello, how you doing, Jeff Menton?
We should connect.
Anyway, there we go. Well, Jess Menton over at Bloomberg, thank you so much for joining us. I think we've hit the end of our 25 minutes here. This was awesome. Thank you for everything you do in our industry and all the amazing work. I always love reading your name and seeing you all over the place. It's makes me feel good to see that good things happen to good people, and just keep doing your thing. And if the Carson team can help, we're here for you. So with all of that, thank you, Jess.
Thank you, Jess.
Yeah, Tori, we're good to go. Let's go to the commercial. We're down to the last one. Kate Hall over here, the Carson team, coming up next. See you, Jess. Thank you.
Before I say that, I do want to preface my comment by saying that I've been truly blessed to be surrounded by amazing leaders here at Carson, both male and female. A great example of this is on our current executive team. Right now, our team has 3 female executives and 7 male executives. And an obstacle I feel I face is the balance between being assertive, but not too assertive that others think I'm bossy, or maybe it's the balance between showing empathy, but not too much empathy that people feel I'm weak. And I think women are more naturally in tune with their awareness, and they are constantly making sure they are coming across in the right professional manner. And I'm not sure if men feel the same way or think as much about it, but I certainly know, personally speaking, is that I do spend probably more time than most just making sure that I'm coming across in the right manner. We can start with our own. So we can create career paths for our females. We can ensure every voice is heard at the table. We can be intentional with mentorship and sponsorship. And we can invest in their development. We kind of re-upped our professional development, advancement development allocations for our people here. And then there are opportunities outside of Carson. We can partner with groups like Rock the Street, Wall Street, and provide education and opportunities for female high school students so they can see that path into our industry. We can create partnerships with universities and support the underrepresented minorities, such as females, again, to get their foot into the financial space. There are so many things we can do, and we just need to be intentional and consistent with those efforts. All of their support has given me guidance when I needed it, or a boost of confidence when I was lacking my own, or a different perspective that I haven't thought of. With mentorship, that's what's so special about women is we always want to help others, to have the other person see what they can see in you. And again, I'm very fortunate to be surrounded by women who truly want me to be the best version of myself. So if you see someone that you admire or want to emulate your leadership towards, ask if they will be your mentor, or simply have a cup of coffee. Not only will this flatter this person, but they will learn and develop from the interaction as well. And I think people would be surprised to know that other women they want to be supportive of others. So my advice is just say, hey, will you be my mentor? Or hey, can I take you for a cup of coffee?
And we are back. Last but certainly not least, Kate Hall. There's a great commercial there with Kelsey. Thanks, Tori and the team for putting that together. I do want to also say, as we're winding down, thank you to Tori, our producer, for making sure we stay on task with all. Sonu and I just talk. We never pay attention to what's going on. We just talk. A lot of hard work that goes into all of this, and it's not lost on us. So thank you. So Kate Hall on our team is here.
Yeah,
Kate,
one of my favorite people in finance.
We like titles around here. Give us your title, Kate, and a little bit about what you do to help the Carson community.
Sure. So I'm Kate Hall. By the way, thank you for having me today. This is a great honor to be on the show. So I'm the Vice President of Alternative Due Diligence for the firm, and my main role is to I've built the platform of options for our advisors across, the various flavors of private investments, maybe some alternatives at some point. We'll get into that in a bit. But I do all of the kind of hiring decisions, bring them to the committee for vote. We did one this morning. And I do all the ongoing analysis to make sure that the opportunities that we have on the platform are performing as we hope they would, and that things are all on the up and up.
I put like this, I would say Kate's popular because people reach out to me because they see me out there and say, hey, you want to do something with alts? Like, I don't know. Go talk to Kate. I don't have an opinion here. I don't even know what you're talking about. So, let's start there, Kate. When someone hears the word alts, I'm not saying it means something different to everybody, but when you hear alts, what does it mean to you, and how do you describe that kind of to somebody who honestly listens to this podcast? We haven't really talked about alts all that often, at least as specific as we're going to today. So what does that mean?
And I'll piggyback on that.
Yeah,
while you answer the what do you think people hear when they hear the word alts, and what do you think they should hear if they follow you?
All great questions. Alts at this point is a very generic term, and I'll get into why. But I think that
alts for alternatives, by the way. So.
Yeah, I think that folks who are not necessarily educated on the space think scary. They think long-term capital. They think I'm going to lose all my money. They think illiquidity, lack of transparency, all these kinds of things. And when I think about alternatives, I think about anything other than stocks and bonds, things that provide opportunities that provide portfolios with different sources of return. And so in that capacity, I really focus on the private side of alternatives, which is private credit, private real estate, and private equity. Alternatives also encompass things like hedge funds and different types of trading strategies and merger arb and long short equity and things like that, which are also considered alternatives. And then even things like commodities, managed futures, et cetera, those are alternatives as well because they provide a different source of return in client portfolios. But what I really think about when I hear the word alternatives and private investments are fun due diligence projects. Nobody likes a fun, complex due diligence project like I do. It's a great way to utilize a process that I developed a long time ago and put some new inputs into it and hopefully come up with a good answer.
No, I think that's great. You made a nice distinction there, I think, between alternatives and privates. Right? Like usually when you think alternatives, like gold can be an alternative. And like
sure.
Brian and I, we manage Carson Housing models along with Barry and Grant, and you have gold in the portfolios, and that's a publicly available ETF, right? I will mention.
Right.
Whereas alternatives, technically, when I think about it, I think of stuff that doesn't zig or zag. You don't know what direction they're going to do, what they're going to do, depending on what stocks and bonds do. Like, not that we can completely predict what that is, but they're non-correlated assets. But a lot of your focus is on the private side of it, right? Where there may be additional opportunities to diversify portfolios, both from the side of returns, but also risk, right?
Oh, definitely. So in terms of diversification from those three big buckets, if you think about private equity, you're getting return sources from things that may happen, like the company being sold, which is going public, which at this point is not happening as much because the IPO market is somewhat closed. Within private credit, you're getting return streams from typically floating rate loans, so that's a different source of return relative to traditional fixed income. And then with real estate, it's sort of a hybrid of both income from rents that are charged and capital appreciation of the underlying assets, whatever that may be, multifamily, industrial, data centers, what have you.
Right. And on the private equity side, I mean, I think generally when private equity is a very large umbrella there.
Yes.
There's different things under it. Like maybe just to, again, none of this is simple, but if you can simplify, what's the difference, just say, between venture and private equity?
So venture is a sub asset class of private equity. It's the earliest stage. It's right ahead of giving, friends and fools who give money to early stage venture, right? That the types of venture that we're in are sort of the later stage that are about to move into the earlier stages of private equity. So yeah, they are the same. Some other or they're one and the same. Some other distinctions that you might make is, there are private equity investments that are in, long lock vehicles where you put your money in for 10 years and you may not see any distribution during that period. You're probably going to see depressed returns at the beginning as the manager moves through the J curve cycle. And typically very large minimums, and suitability is for clients who have at least 5 million in investable assets. This is compared to we're seeing a proliferation of semi-liquid investments that clients can invest in across all of the privates. And in those strategies, you have a semi-liquid situation where the potential is to take out 5% every quarter. But those strategies, I call them private equity light because they're typically invested in things like secondaries. So it's not like going into the type of fund that I just described with a long lock. You're getting into it's basically a great opportunity at this point because you can get into private equity investments that need their LPs and GPs that need liquidity. And, with the IPO market basically shut, and now with the new administration making things a little more difficult, this is a great way to get exposure to the asset class at potentially a discount. The discounts are slim, but what's really great to see is that the returns that you're getting out of the secondaries are really generated by rolling up your sleeves and generating growth and cash flow, capital appreciation, versus just getting a return that feels kind of like, did I really get this just because of a secondary markup?
Right. So that's interesting. I mean, I'm learning a lot just listening here. This is great. What are some of the risks though? Like I've always heard, and again, this is, what I've heard. Sometimes you want your money back. You can't get your money back as soon. Liquidity can be a risk. What are some of the risks when we talk about privates?
So a lot of people focus on illiquidity, and there's a blessing and a curse with that. Okay. The curse is that with clients who may not be prepared for having their money locked up, it's scary, right? You may have an unexpected event come up and you need the cash, which you're probably not going to get. The blessing is that that managers have time to execute their strategy. They have confidence that they're going to have capital in their strategy to do what they need to do. And so, from that standpoint, illiquidity is a good thing. It's also a good thing if you are in a fund where you have a mindset that is longer term and you are comfortable with the strategy. And let's say we saw this happen a couple of years ago with one of the real estate funds that I won't mention. And there were a bunch of redemptions all at the same time. Mm-hmm. If you're not ready to exit that strategy and your neighbor is ready to exit that strategy, your investment may be adversely affected by folks who want to get out for whatever reason. And so you want to be invested with people with a like mindset to keep their capital invested for the long term, not get scared because of one reason or another and want to redeem.
So it's safe to say this is probably isn't for everyone then. You kind of mentioned like-minded people. Is this for everyone, you think?
I think it's so. I think clearly there are suitability issues or requirements to get into alternatives. So that's sort of the low bar. I think if you have a long-term, medium to long-term mindset for how you want to allocate your portfolio, and you are well educated by your advisor about what you're buying, these are great, they're nice diversifiers for a public market portfolio that's going to have more gyrations in I call it the statement reading experience. You're going to have a little bit easier time with a lot of, private market stuff on a shorter term basis. And we can get into the valuations and other risk. You need to really understand how your positions are being marked.
Like on a public, if you invested in public equity markets or even ETFs, whatever, you can look at a screen and see what the valuation is. What is the net asset value? What's the price, right? Private markets, you can't see that. That's what you mean, right?
Right. Well, so with the semi-liquid strategies, you can see, more timely valuation marks than with if you're in a lockup LP kind of structure. But I think we're seeing this year. I mean, obviously the markets have been very volatile, and having some diversification in your portfolio clearly has helped returns.
Yeah.
But private markets are not the end all and be all. Like portfolio, there is a place for public and private diversification and roles that the client should have exposure to.
At the margin, do you think it improves? I say this very cautiously, improves investor behavior, because if you're assuming everyone's on the same page with respect to who's investing in a particular alternative fund or vehicle, whatever it is, but it is a long-term investments. And when Ryan and I are always talking to advisors, clients, even like, yes, your investments tend to be long-term. Don't act based on what markets are doing today or tomorrow. And I think about like private markets, you don't see it. So maybe I don't know. I'd love to get your perspective. Does that make you at the margin a better investor because it's long-term, you already accepted it, you're not going to pull your money out, maybe because you cannot pull your money out?
Right. I mean, that's kind of also part of the blessing of illiquidity. You can't make those knee-jerk reactions, right? And so like if you know that even if you put yourself into a 10-year lock with maybe a 2 or 3 or 5-year extension, you may be allocating that capital for your heirs. Okay. Mm-hmm. So you don't care about the interim volatility, or it may be an investor who has run his or her own business, and they understand, they're not interested in the public market, gyrations and reporting and such. Like they've done this themselves, so they're comfortable with lockups.
Right. And a large part of what you do is education. And like you mentioned, advisors have to educate their clients, but I feel like, a lot of advisors are not familiar with alternatives.
Yep.
But you are, like some of us on the team learn a lot from you as well. And speaking for myself, as every time I talk to you, how big is that education piece? And, what do you, and because of you, Carson, bring to the table in terms of educating our advisors about
the education process is every day, just like it is on the public side. I've been doing this for a long time, and I think this is a great piece of advice for folks who are getting into the business today, is to continue that education process. It's not, and even for advisors, it's not just allocating to a strategy or two and kind of walking away from it. You really need to stay in touch with what's going on so that you can educate yourself and your clients, because you will get questions. I mean, all investments have bumps along the road, right?
Sure.
And so keeping up with education, there are all kinds of resources for that. We have the Content Hub at Carson, where I post all kinds of things about the individual strategies and markets, and kind of everything from what are alternatives to how to prepare for a meeting, discussing alternatives, things like that. LinkedIn is actually a really great tool. There are a lot of folks that you can follow with good information. I do it myself. The big managers, Blackstone has one of the best education programs I've seen, that advisors can go through their modules and really learn the basics if they're new to the space.
So you mentioned some managers. I think it seems to me like a decent part of your day can be talking to managers, right? That everybody reaches out and says, we've got the best thing ever. I hear it all the time. Sonu hears it all the time. You almost have to have, hope I can say, like a BS detector, because you've done this for a long time. Yes. How do you know which manager means it? How do you know which manager, maybe there's an issue there? I mean, of course, the Bernie Madoff example, it was a big scam the whole time. How can you kind of read through that, Kate? And what are some clues you've learned that people aren't maybe telling you the truth sometimes?
I've been doing this a long time, and that meter in my head is very sharp.
How are we doing the last 20 minutes in your head? We doing okay on the BS meter last 20
You're doing
minutes?
Okay. You're doing okay.
Okay, good. I say, all right, that's good.
Yeah,
Make me feel better. All right.
So that's a great segue into preparing for meetings. I mean, I go through stacks of paper to prepare for, especially on the private side, and even in the hedge fund world. A lot of times you get an hour to speak with these folks, and so you got to be really prepared, and you have to.
That's not a lot of time, right?
No. it's kind of, yeah. I mean, you can always have follow-up questions and such, but I spend a lot of time putting agendas together. And what are the key questions, both before managers are hired and afterwards, that need to be addressed? Because like the days of sitting in a manager's office all day long are gone, way gone. But in terms of like, I get emails all day long with potential new investments, and you can like, at this point in the semi-liquid space, I really prefer the big guys because they have really talented people. The transparency is better. And, you also want trustworthy people. And I just know when I hear something that sounds ridiculous, or like what I really don't like is the really hard and fast sales pitch. People who talk really fast, like, no, not so much. Like, I don't like, I know what you're trying to say, but just tell me in English and tell me like, slowly.
You don't want to run afoul of Kate Hall's process that way.
In my prior life, I was called a bulldog because one of my other favorite things about this business is coming up with really good questions. And
you do. I've been on calls with you, and I will attest to that. So. And
that's my second piece of advice for the young folks. Never go to a meeting thinking I'll wing it. I'll just get through the meeting. Mm-hmm. You always, I probably over prepare too much. But the over prep that I do always ends up being a trick in my back pocket for a call, the next day or the next week or what have you. So you always want to make sure that you've got your facts straight, and you've gone through all the diligence stuff that you need to do, and come up with really good questions that are not just like check the box kind of things, but like really trying to, connect the dots in what you're hearing from a manager.
So being over-prepared is not the worst weakness, I think. It reminds me of the Michael Scott in The Office. What's your biggest weakness? Yeah. I care too much. I try too hard. And it means too much to me, something like that. We've got a couple minutes. It's amazing how fast this goes. I do want to talk a little bit about your career and kind of Carson and kind of weave some of this together, because you've kind of started hitting at it. What are some ways that you see getting work with financial advisors every day and talk to really smart managers that Carson's kind of opening the door for female advisors, females in the industry? And what are some reasons that you like working at Carson as a female as well? Take that however you want, but I think it's something I think a lot of listeners want to hear.
Sure. I mean, I've been in a man's world, I think, since I was born. I've been doing this my whole life. And I really quickly became comfortable with talking to men significantly older than I am, or at the time older than me. And because I was prepared, and once I opened my mouth, they were like, okay, you're allowed in my office. or having a voice, not just a seat, but a voice at the table. At Carson, one of my first experiences was a dinner meeting on the 6th floor with the crowd of executives up there and an outside manager. I was the only female, and it was a blast. But because they welcomed me as one, I was just one of the people at the table, and I spoke and they listened, and it was great. I think at Carson, it's very welcoming. Maybe it's because of my background, but I don't even think about men versus women. I think about, we're all in this together. Yep. And we have a mission to serve our advisors and serve our clients so that they reach their financial goals and dreams and what have you. And so, for me, it's just been a great opportunity.
That's awesome.
Love it.
On that topic of the process, right? And everything you bring to the table, on the public side, a lot of the stuff we do is obviously on the public side. Let's say I want exposure to the S&P 500, easy enough, right? Or to the market, I can go buy an SPY ETF, right? S&P 500 ETF, not a recommendation, by the way, right? But still, right? But on the private side, it's harder, right? I want private equity, but you can't just go get private equity, right? You have to pick and choose and select. And I feel like the most important thing, it's important even on the other side too, it's people, right? You mentioned earlier about transparency and trustworthiness. Yeah, the 2 T's, but people. I feel like that's the most important thing, and that's what ultimately your BS detector is, detecting.
So on the BS detector, like if you go into a manager meeting and they're struggling, like their performance is behind the eight ball, and they can't really explain to you or won't explain to you why they're having trouble and what they're doing to correct, to change, like tweak their process or like make it better, like learn from the mistake and admit that the mistake happened. That's a problem. And
is it a problem when like sometimes performance may be too good to be true as well? And
yes, and like digging through performance and really figuring out how it was generated and asking questions like that, you find out what the manager's makeup really is, which is what I spend a lot of time trying to understand what makes people tick. So yeah.
Yeah, no, it seems like the people part is so important, right? I think this is, and I mean, this is a commercial for our team too. I think one thing we do well, obviously, Ryan and I always talk about markets and the calls we make and things like that, right? But across our team, I feel like we have so many of us have done due diligence for such a long time. And one thing that comes out of that, including when you and I talk, right? We talk often enough, and you're telling me about the last meeting you had, and that teaches us, like what good managers do and what bad managers do, and how to, everyone makes mistakes, but you don't want to make big mistakes.
No, exactly.
You do due diligence, you see so much of this happening, and I feel like at the end of the day, it makes us a better investment team all around because of that aspect of it.
Yeah, I mean, all managers.
Yeah,
all managers make mistakes. You just want to see that they admit up to them, learn from them, and move on down the road.
That's well said, Sonu. Our team, we're 15, 16 strong, and we've got a lot of strengths. Of course, there's always some weaknesses, but I think we don't look at it like, oh, this is your job or my job. Our job as a team is to get the job done, make sure our Carson partners are happy, and at the end of the day, keep their clients happy as well. And it's challenging at times. That's just because the market's challenging, but we always have a lot of fun doing it. One thing I was thinking here, like Warren Buffett, okay? If you talk, like most people listen to this Facts versus Feelings podcast, Warren Buffett, oh yeah, he's a stocks guy, he's an icon. Who's like an icon in the private side of things that maybe we've heard of, but I didn't quite realize they're big in your world, Kate?
Well, like the big guys at Blackstone or the big guys at Apollo, like, the big shops are the ones, the guys at Apollo, Blue Owl, the ones that you see in the news are, kind of people that, I mean, definitely Blackstone, is sort of a leader in the private market space. Yeah. And so to me, like they have been really successful in, scoping out trends in investments that they can capitalize on, and that's a really special skill set that not a lot of people have. And they also have, obviously massive resources to execute on what they do. But people like them are, who I definitely pay attention to.
We've got a couple more minutes left with Kate Hall on our team. This is the Women's History Month special live stream of Facts versus Feelings, building community for women in finance. Sonu, we've been doing this for almost 2 hours. Honest to goodness, it's gone really, really fast. I guess one more from you, one more from you, one more from me, and then Kate's off the hot seat.
I'll pick up on exactly what you just said about like the big players, right? With this stuff, everyone's always looking for, I want this niche thing that nobody's found yet and things like that. But because of what we talked about, transparency, trust, education, all of these things being as important as it is to, a space that most people are not familiar with, is bigger better?
Definitely in the private credit space. I think one of the risks out there today, I didn't talk about it earlier, is you're seeing a lot of new entrants come into the space who are not crossing their T's and dotting their I's as they should on the underwriting.
Right.
We will see who's swimming naked at some point. And
there's a Warren Buffett quote. There we go.
And the big guys who I'd prefer to be with, who have the resources and expertise and balance sheet, will be the players who can scoop up, deals at pennies on the dollar that the guys who don't really know what they're doing are doing today. And so that's one thing that it's a blessing and a curse. It worries me about all of the new guys getting in and gals getting into private credit. Stick with the big guys there.
Yes. Guys and gals.
And God, I'm sorry. I'm used to being in a guy's world.
No, you said. I thought you said it, and that's why I was just picking up on that.
This was great. This again, Kate Hall on the Carson Investment Research Team. I mean, this is hopefully another example of all the different things that our investment research team does. They kind of see Sonu and I out there and different people, but there's people, really smart people like Kate that have done this for a while that know their stuff to continue to help our Carson partners at the end of the day grow and grow faster than the industry average is what we're trying to do. And that's what we've been doing for a long time. Kate, we've got like, I don't know, 90 seconds or so. So I'll just kind of give you a real nice lob and you can take it however you want. Let's say there's a little girl listening out there. She wants to get into finance and she wants to kind of do something that you're doing. What you already gave some advice, working hard, being over-prepared. What's some other advice you can give for somebody out there who wants to get into the finance world, maybe kind of from the female point of view?
So honestly, I majored in English and Spanish, so I did not have a finance background.
I like tacos. I could say taco. Yeah.
But I think it's really helped me because my strength, I mean, I can do the quantitative stuff to a point, not quite like Sonu, but the qualitative stuff is what can really get you in trouble with hedge funds and private investments, and so that's kind of where my strength is. I would say focusing on that kind of stuff. Obviously, the education, finding a mentor, as Kelsey talked about on the commercial. And guess what? Once you get through being or having a mentor, be a mentor. I love mentoring a person or two on our team. I love like sharing what I know. And then the last piece of advice I would say is always raise the bar. Don't stay stagnant in your work product. Always try and do it better, bigger, maybe not necessarily bigger, but like always, figure out ways to improve and, put out the best product you can each time you work on something.
You do that every day. So
I try really hard.
Oh, that was awesome. If you're listening to the live stream, please don't log off yet. But if you're listening to the weekly podcast of Facts versus Feelings, this was awesome. This entire recent 2 weeks that we've just done and shared some of these Women's History Month podcasts that we've done live stream. This is amazing. Kate, thank you so much for joining us. We really appreciate it. I know our Carson partners appreciate it and their clients appreciate it. Maybe they don't realize it, but the work that you do really does help move the needle to make our team truly, and we're biased, but the best investment research team that's out there. So with all of that, we're going to sign off on the live stream. You get one more guest coming if you're listening to the live stream. But thank you, everybody. Appreciate it. We're going to bring on a special guest right now. Thanks, Kate. Appreciate it.
Thanks, Kate. All right. I think we're almost ready.
Okay. So I had to do a little segue for the recorded podcast versus the live stream. So I do want to thank we've got Blake here in a second. I've heard we've had thousands of people have listened to this live stream so far over the past 2 hours. We're really excited about that, and we're going to keep doing live streams if it makes sense. And I know we love doing them. So Sonu, we've got someone else on the screen. Let's talk to him.
Yeah, extra special guest from who I've known ever since my time here at Carson. It'll be 6 years for me in June of 2025, right?
Yep.
In June of 2019. And Blake, who you'll probably see on screen. Yeah, there he is. Blake's been here longer than I have. He's like one of the veterans now. So
only by about a month, Sonu. Just about a month of seniority on you.
Yeah.
Well, Sonu's 6 months older than me, and I always point out he's the old guy. So that's okay. So
Exactly.
Blake, obviously this is Women's History Month, and last I checked, you're not necessarily a woman, but you've done some really awesome work to help women in our industry and some things you push the envelope on here at Carson's. Tell us a little bit about yourself, but kind of why you're joining right now on a Women's History Month podcast live stream.
Absolutely. Ryan and Sonu, thanks so much for hosting me and for hosting this special live stream. My name is Blake Anderson. I work as an associate portfolio manager here at Carson Group. I run a few of our internal equity SMAs, including a large cap growth mandate, technology and AI focused mandate. But what we're here today to talk about is our Women's CEO strategy. It's really focused on investing in this women in leadership theme and pushing the industry forward. Here on Carson's investment research team, we knew we could do more to help advance this conversation than just talk about it. We really wanted to provide an avenue for forward-thinking advisors wanting to lean into this theme, an avenue to walk the walk as well. Debbie talked about it for a moment, but how underrepresented women are in finance, we really wanted to provide an avenue to help bridge that underrepresentation. we developed our Carson's Women CEO strategy to help out with this. Our Carson's Women CEO strategy invests in some of the largest S&P 500 companies with a female CEO. We believe we're one of the first firms in the industry to offer such a targeted solution like this. As we looked around at other offerings, we didn't want to just do something cheaper. We wanted to do something different. We researched other offerings and really saw that some of the inclusion guidelines for some of their public ETFs might have been a little loose per se, or maybe not thematically pure enough to really help move this conversation forward. We saw an opportunity to launch our strategy with a clear value proposition. Invest in women who have broken that glass ceiling and help them tell their story in an effort to bridge this underrepresentation.
That's awesome. What has been the, and that's one, again, we were just talking with Kate about, again, from your bias, why we think we're the best investment research team in the business. And it's include folks like you, right? Even though it's like Brian and I in front and center all the time, but it's folks like yourself. And this is the advantage of having somebody who really knows the bottom up equity space as well as you do. And every time I have a question on AI and technology, like you're my go-to person, right?
Yep.
But what's been the impact of this, and how important has this women CEO strategy, been for our advisors and especially to connect with clients?
Yeah, two avenues of impact that I see that I'll talk about. One from the bottom-up stories of the companies, but as well as the advisor-client relationship impact. I think owning a strategy like this that owns individual equities can really help highlight the women CEOs, the innovations that they're bringing, and the companies that are really moving forward in the index. And I'd like to highlight two stories that give really great examples of this. The strategy owns one of the largest biotech firms in the world, which under the leadership of their female CEO has developed a first-of-kind non-opioid pain reliever. Now that's a lot of jargon to say that this treatment is really seen as a breakthrough in the medical industry. It's helping deliver better care sooner to patients and is really seen as an example of a female CEO who's been willing to push the boundaries, and I think ties in to so many of the conversations that we've heard today. Another company in the strategy is one of the world's largest semiconductor design firms. Under the leadership of their female CEO, brought back the company from the brink of insolvency, took on one of the industry's largest competitors, and has really planted their flag in the industry. I think both of these stories and other stories of the female-led companies in the strategy serve as powerful examples of how women in leadership are transforming the world around us. Debbie talked about it for a moment as well, but there's an unfortunate stereotype of women in finance that they might just be caring with a C. Maybe they help foster teamwork or collaboration, but that it might be the end of their leadership roles there. I think highlighting stories like this in the strategy also help show that women in leadership can be daring with a D, daring to push new products forward and can be just impactful as their male counterparts. So really telling the stories of these women CEOs I see as impactful to align your investments with your values. And maybe on the broader client-advisor relationship point, our partners tell us that this investment strategy helps strengthen their connection with households and is a unique avenue to engage with female business owners. Debbie Taylor also brought the stat that nearly $50 trillion of household wealth could be passed along to female heads of households. Getting them engaged in financial wealth planning conversations earlier will certainly be impactful, and we think this is a differentiated way to do it.
Well, I think it's just another way of showing that the way Carson thinks, maybe a little different. Like you said, we were pretty sure we're like the first place to do this. Maybe if there was somebody before us, I don't know, but we're doing things like this. And the other thing is,
and hopefully do it in a much better way.
The other thing to point out, we've seen the data. The data is public. CEO-run companies, you know what happens to their stock prices? They tend to do a little bit better than male-run stock prices. So we're just going to leave it there. So I mean, the mic drop on that. But there's also some really neat things that you're doing, Blake, to help our Carson partners and pushing things like this. So at this point, Blake, we're going to say goodbye to you, and Sonu and I are going to sign everything off. But thank you, Blake, for joining and talking about how you're helping our Carson partners. So Blake can leave, Tori, and then Sonu and I will kind of do a little roundout. There we go, perfect. All right, man. I'm starving. By the way.
I didn't have lunch.
How was your milkshake? How was the milkshake?
Yeah. It was great. It took me like an hour and a half to finish it. By the time we got to Kate, it was done.
There you go.
But I'm not that hungry.
I might go get one now. Maybe I'll go get a milkshake now. But listen, we need to wrap this up. Sonu, this was an amazing 2 hours. Give your thoughts and I'll kind of bring us home.
I think Blake mentioned, I love that he ended with the stories, and we started the whole thing talking to Lindsey about charts and stories and narratives, creating that narrative and seeing. Sometimes you want to create charts and look at the data to see what the market narrative is as well, right? And how your narrative is different from that, and maybe there's a disconnect. And if you're managing portfolios like us, you try to take advantage of it. I'm not saying we always do, but then that also gets to some of the mistakes that you make, and you learn from the best people, and including the folks Kate talks to. And also, it's not just about investments, right? It's about everything that Carson, for example, brings to the table, including planning and taxes, especially. Right. This is something that we are doing in a big way. So really pumped about that. And, Debbie's been amazing in that front. And, like I said, it's about creating a better story for our advisors and our clients.
No, well said. So again, we're going to wrap up here our 2-hour special live stream to celebrate Women's History Month with Facts versus Feelings. Definitely big shout out to Tori, our producer, who helps us every step of the way on this. I know compliance is going to help a lot. Other members of marketing are going to help with all this to put these together. Not necessarily easy. They're a lot of fun to do, but not always easy. So thank you to everybody helping us there. And just thanks to all the listeners. And we've had, again, thousands of people so far today have jumped in and out and watched these fun discussions with some true titans and leaders in the industry, female leaders in our industry. And Sonu and I are just honored that we got a chance to talk with them today. And hopefully everyone enjoyed this live stream. It's March Madness. The brackets are coming. I one more shout out. There's my X pin. Right. I'm going to Dayton to watch Xavier. 9-10 Eastern tonight, a True channel. I don't know if you get the True channel, but it's the NCAA tournament. We snuck in, so let's hope we get a win for my Xavier Musketeers. With all that, everyone, thank you again for taking a lot of time out with the Carson team today. We enjoyed doing this. Hopefully you enjoyed it, and we'll keep doing them. If you keep coming, we'll keep doing them. But enjoy March Madness, everybody. Official sign off. I'm going to get some food. Take care, everybody.